is in front of your screen. It says that which of the following best define the merchant export. So let's see the option. Option A says that Indian trader export goods after procuring them from domestic supplier. So option B says raw material are sourced from one nation and then exported to other. And the option C is that goods that bypass Indian territory and are directly imported from one country for export to another. Option D says export transaction where the origin and destination of goods remain the same. So let's discuss each and every option. As per option number A, Indian trader export goods after procuring them from domestic supplier. This is the common type of export but not a merchant export. Here we are dealing with merchant export. It is called normal export, right? Then this is normal export in which Indian trader buy goods from Indian manufacturer and then ship abroad. For example, a Delhi based exporter buy handmade carpet from Jaipur and export them to the USA. So this is the normal export option. So this is incorrect because in merchant export goods do not come from India. Then option B says that raw material are sourced from one nation and then exported to another. This sound close, but it is more likely a global sourcing, isn't it? It is more likely a kind of global sourcing, right? A company buy raw cotton from Egypt, process it in Vietnam and export the final product to Europe. However, in merchant export the trader do not process or manufacture anything. So that is why this option is also incorrect, because merchant export do not involve ready-made good. So merchant export involve what? Ready-made good, right? There is nothing like processing here. Now option C says that goods that bypass Indian territory and are directly imported from one country for export to the other. Yes, this is the exact definition of merchant export. You know it very well that traders simply buy from one foreign country and sell to another without the good ever entering India. For example, an Indian exporter orders electronic chips. An Indian exporter orders electronic chips from Taiwan and directly sell them to buyer in Germany. So it orders from Taiwan and it sell to the buyer in Germany, right? So this is example of merchant export because the goods never entered India and are traded internationally. And option D says that export transaction where the origin and destination of goods remain the same. So this statement is vague and does not define merchant export. It could refer to regular export where goods move from India to other country without any intermediary role. So this option is also incorrect, right? Because merchant export always involve a middleman, like the Indian trader. Merchant export always involve the middleman, right? Some Indian exporter is there, Indian trader is there, but goods never physically enter India. So that is why option number D is also incorrect, and option number E says that none of the above. So none of the above is also incorrect because since we found the correct answer to be option number C. So what is the key takeaway? Let's summarize what we have learned in this particular question. We have learned that when we talk about merchant export, it means we are buying from one foreign country and selling to other without good entering India, right? For example, Indian trader buy goods from China. So you buy goods from China, right? Indian trader buy goods from China and directly sell them to the buyer in USA. The goods is not entering India. So it is first thing we learned is that. Second thing we learned is that this is not a normal export because normal export involve Indian product. Also there is no trade of raw material. Merchant export deals in finished goods, not raw material. Always remember, merchant export always deals in finished goods. There is nothing called raw material involved here. That is why we can say that option number to this particular question, option number C is the correct answer. Now let's see the next question. The next question is, let me show you. When should the bill of entry be submitted for import made on usance term? So these are the 5 options given before you, right? So this question is about bill of entry. So option A says that once the goods arrive in India, exactly on the due date of payment bill. Option C, at the time of making an advance payment for import. Option D, either on or before the due date when the payment is scheduled. Option E, all of the above. So very good question it is. So let's go through the first option. The first option we have, once the goods arrive in India. You know, it seems logical, but it is not always correct. You know, when goods arrive, they go through customs, but that does not mean that bill of entry must be submitted immediately. For example, if a company import machinery from Germany, so you know, suppose this is Germany, right? And a company import machinery, right? Company import machinery from Germany and the shipment arrives in India, but the payment is due after 90 days. You know, 90 days is a usance term. So again I am repeating that a company is importing machinery from Germany, the shipment arrive in India and payment is due after 90 days, which is the usance term. So the bill of entry is usually required when making the payment, not just when the goods land, right? So when the goods arrive in India, this is incorrect because submission is linked to payment due date, not just arrival, right? Then option B says that exactly on the due date of the payment bill. Yes, this option is partially correct, but it is risky. If the importer wait until the exact due date, any delay in documentation might cause compliance issue or penalty. Let me give you an example to substantiate it. For example, suppose an importer has a 60-day credit period. 60-day credit period, right? Importer has 60-day credit period for an import from China and submit the bill of entry exactly on the day 60. He submit bill of entry exactly on day 60. Any process delay could cause legal and financial issue. So that is why it is also incorrect, because submission should be on or before the due date, not just exactly on it. Option C say at the time of making an advance payment for import, right? So this apply to advance payment, but Yuzhan's import do not require advance payment. You see clearly written Yuzhan's term. When I say Yuzhan's term, it does not require advance payment, right? Yuzhan's means deferred payment. Whenever I say Yuzhan's, one thing that should strike your mind that it is deferred payment, right? It is what? It is deferred payment. You should know it. So it is a deferred. It is a contents. What we know that this Yuzhan's is means deferred payment. So this situation does not apply. We are talking about option number C, right? So for example, if the importer pay upfront before receiving the goods, it is side transaction, not a Yuzhan's transaction. So that is why option number C is also incorrect, right? Because Yuzhan's term allow payment later, not in advance. Option D said either on or before the due date when the payment is scheduled. Yes, this is the correct answer. Trade regulation require bill of entry to be submitted before or on the due date to ensure a smooth financial transaction and compliance. For example, an Indian company imports electronics from Japan with 90-day Yuzhan's period. So this is Japan, right? And it has imported electronic item with 90-day Yuzhan's period. So the payment is due on payment is due on 10 October. Payment is due on 10 October. Okay, let's take for example. So the bill of entry must be submitted on or before October 10 to avoid any regulatory issue, because this ensures compliance with foreign exchange and custom regulation. That is why D is correct, and E is not correct since we found that A, B, C are incorrect. So the option E is also incorrect. So what we have learned in this question, whenever you see this word called Yuzhan's term, it means deferred payment. It completely means deferred payment, means deferred payment for import pays later, not upfront. Now second thing we learned is that bill of entry has to be submitted, right? So bill of entry submission, that it is required on or before the due date of payment. That is why option number D is correct. The third thing we learned that it is not only on arrival. Payment date matter more than the goods arrival date. So when the goods arrive, it does not matter. What matters is the payment date. And if there is a late submission, then obviously penalties and compliance issue risk is there. So I hope this make you concept clear. That is our second MCQ of this session. Now let's move over to the third MCQ. The third MCQ you can see, which were asked in the previous year question, that this was regarding a foreign bank account. A foreign bank hold an account in Indian rupees with an Indian bank for local transaction, right? So this is the condition. We have to answer which is this type of account is called. So option A Nostro, option B Loro, option C Vostro, option D foreign currency account, option E interbank account. What do you think? You should first try yourself and then listen to the answer. So let's analyze each option one by one. The first option is Nostro. When I say Nostro, it means what? It means our account with you. Our account with you, right? So Nostro account is an account that an Indian bank hold with a foreign bank in that foreign bank currency. For example, SBI. So SBI want to do transaction in US, right? So it open an account with JP Morgan. It open an account with JP Morgan in USA, holding US dollar. So SBI call this a Nostro account because it means our account with you, that is JP Morgan. Right, this is incorrect because in the question a foreign bank is holding an account in India, not the other way around. So this is wrong. Loro account. So Loro means what? Their account with you. Loro means their account with you, right? So it is used when a bank refers to another bank account. For example, Bank of Baroda refers to SBI Nostro account with JP Morgan. Then for BOB it is a Loro account. Like Bank of Baroda, it refers to SBI Nostro account with JP Morgan. So for BOB it is a Loro account. This is also incorrect because Loro account are used by a third bank to refers to another bank account, which is not the case here. Now let's see the option number C, Vostro account. Vostro means your account with us. It clearly means your account with us, right? So it is an account maintained by foreign bank with an Indian bank, Indian rupees for local transaction. For example, HSBC UK want to do business in India and hold an account in Indian rupees with HDFC Bank in India. For HDFC Bank, this is a Vostro account. So Vostro account is correct. That is why option number C is correct. Option D say foreign currency account. This is an account where a person or company hold foreign currency in Indian bank. It is not specific to foreign bank, right? So an Indian exporter might have foreign currency account with SBI to receive payment in dollar from international client. So D is also incorrect. Option E say interbank account. You know that interbank account are used for settlement between two banks, either domestically or internationally. They are not specifically Vostro or Nostro account. For example, when ICICI and HDFC Bank transfer fund between each other, they use an interbank account. So that is why E is also incorrect, right? So what is the correct answer? Option number C. So what we have learnt in this question, that Vostro account means your account with us, a foreign bank account with an Indian bank in India, Indian rupees. So this is maintained in Indian rupees, INR. Then we talk about Nostro account, which is our account with you, an Indian bank account with a foreign bank in foreign currency. Then we talked about a Loro account, which means their account with you. It is used by third party to refers to another bank Nostro account. And finally, we talked about the foreign currency account, which is used by individual or companies for holding foreign currency. And interbank account, we know it very well. So I hope this make you concept clear. Please hit the like button if you think that this explanation was useful. And for those of you who want a study material related to the foreign exchange certification course, so you can see on our app, that is JIB and CIB Made Simple, we have made a course in which you can see the content right here. There is a separate folder for theory and MCQ PDF and a separate folder for previous year question. In the theory and MCQ PDF folder, you can see that I have added module A, module B, module C, module E, module E. Like if you go to the module number C, you can see that for every unit I have provided theory and MCQ PDF. For unit 10 also theory and MCQ PDF. Similarly, I have added MCQs for each and every module it is present. And now you can see that besides theory and MCQ PDF, we are having previous year question also, right? We are adding more PDF we are adding. So if you want to access to this course, you will see the link of the course in the description section, and it costs rupees 200 only for this entire course. For more detail, you can WhatsApp me on the number shown on the screen. Now let's come to the next question. So this is the number. You can WhatsApp me on this particular number highlighted on the screen. Now the question number 3, just wait a minute. Yeah, so question number 3 is on your screen now. I think it is 4 number question. So the question say a customer want to send money abroad through a demand draft for their child education. What exchange rate will be applied for debiting the customer account? Right, so this is the question. So let me move to this question later. Before that, let me ask you one more question here. Yes, first of all, try this question. I will move to that question later. Under the liberalized remittance scheme LRS, which category of entities is eligible to remit fund abroad? Right, this is the question. Very nice question it is. So this is about the liberalized remittance scheme. So first option say trust, corporate, individual, HUF, NRI. Please think answer in your mind, and now let me explain. Option A say trust. You know, trust are not eligible under LRS. Because question is asking which is eligible. Trust is not eligible. Why? Because trust are legal entity formed for charitable, educational or investment purpose. They cannot remit money under LRS. Instead, they need a special RBI approval under FEMA regulation. Imagine a charitable trust in India. He wants to donate money into a NGO in USA. It cannot use LRS, but it must seek RBI approval. Option B say corporates. See, corporates and companies are not eligible under LRS. Business and company cannot remit fund under LRS. They must follow separate FEMA rule for overseas investment. For example, a software company in India want to send money to buy cloud service from the USA. It cannot use LRS but must go through corporate remittance guideline. So this is also incorrect. Individuals, correct. Under the LRS, only resident individual, including minors. Minors are also included, right? They can remit up to how much? 2.5 lakh dollar. US dollar per financial year for a certain purpose. This includes education abroad, foreign travel, medical treatment, gift and donation, investment. For example, if an Indian student want to study in Canada, their parent can send tuition fee using LRS up to 2.5 lakh dollar per year. Right, so this is option number C is correct. What about HUF? HUF are also not eligible under LRS. You know, Hindu undivided family is a legal family structure in India. It is not allowed to send money under LRS. If an HUF family wants to invest in US stock, they cannot use LRS but must follow a separate RBI rule. What about NRI? So an NRI cannot use LRS. You know, LRS only applicable to the Indian resident. NRI can remit money through using different rules under FEMA like NRE, NRO. So NRI working in Dubai want to send money to his friend in USA. He cannot use LRS but make transfer fund using NRE and RO account. So what we learn from this question? See, every question has a learning. We must learn. We don't treat MCQ just like we read the question and we get the answer. No, every question learns, because sometimes you know that different question can be framed based on it, based on the learning we have. So the first thing we learn that LRS only allow resident individual. It only allow what? Resident individual, right? And the limit is how much? 2.5 lakh dollar per year. Let me show you. So here I have highlighted the key point: resident individual. Limit is 2.5 lakh dollar per year. And for education, what are the permitted transaction? You can see clearly written here, like education, travel, medical treatment, right? And you know, trust, corporation, HUF, NRI, they are not eligible, and NRI can use other guidelines, other remitting method like NRE or NRO account. I hope this make your concept clear. Now let's see the next question. The next question is, what is the maximum time allowed for completing the payment for imported goods from the date of shipment? Very nice question it is. So let's break it down. Option A says 90 days, 6 months, to 70 days, 1 year, 360 days. What do you think? So let me answer this question. Option A is 90 days. This is entirely not correct, because in some special cases payment may be due within 90 days based on trade agreement. However, the standard RBI guideline allow up to 6 months. For example, if an Indian company import raw material from China, so this is China and this is India, an Indian company imported some raw material from China, right? And their agreement states payment it is due within 90 days, right? So they must pay within that time. So standard payment time is longer. Now option B says 6 months. Yes, as per RBI and FEMA guideline, importer must complete the payment within 6 months from the shipment date. This ensures timely international trade settlement. For example, an Indian, like in the previous case, from China it has imported goods, right? So suppose it has imported on 1st Jan. It has imported on 1st January, right? So they must pay by 30th June. That is the 6 month. The importer must pay by 30th June, right? That is the 6 month. That is the maximum time allowed is 6 months. 270 days is not wrong answer, right? And 1 year is also wrong, right? So the correct answer is option number B, that is 6 months. So what we have learned, that RBI allow import payment to be completed within 6 months, right? That is what we have learned from this particular question. Quite easy to understand. Let's move to the next question. So the next question is, in ITC HS classification system used for import and export, what does HS stand for? So very good question it is. So option A say harmonized structure, option B say household source, harmonized system, handling strategy, and health standard. So you know, the first option A is not correct. Why? Because the harmonized is correct, but harmonized structure is not correct. International trade classification follow a structured system. Option B say household source. Obviously this is not correct, because household source may sound related to the consumer good, but it has nothing to do with import export classification, right? The ITC HS, right, system categorize all traded goods. It categorize what? All traded goods is categorized by it, not just household related category. For example, whether Indian import machinery, chemicals, textile, the classification remain the same. Option C say harmonized system. Yes, this is correct. You know that harmonized system is a globally standardized method of classifying traded goods. So it is developed by whom? WCO, that is World Custom Organization. So this is developed by the World Custom Organization. It helps in uniform classification, tax calculation, and custom procedure. In India, it is used in the ITC-HS. What is ITC-HS? Let me write down the full form. ITC stands for Indian Trade Classification. Indian Trade Classification. That is the full form of ITC. Right. For example, if India export rice or import crude oil, the HS code determine taxes, duties, and trade policy for these products worldwide. So HS stands for harmonized system, a universal trade classification method. Handling strategy, this is wrong. Handling strategy deal with logistic and supply chain, not the trade classification. And last option say health standard. Obviously this is misnomer and this is misguiding, because it applies to the food, medicine, and public safety. Right. So what we learned from this question is that HS stands for harmonized system, a global trade classification system used in export and import. It is developed by the WCO, that is World Custom Organization, and help standardize international trade. In India, ITC-HS is used to classify product for tax, customs, and policy regulation. Right. I hope this make your concept clear. Don't forget to hit the like button if you really think that this concept was useful to you. Now let's see the next question. The next question is, as per FEMA, according to the FEMA regulation, what is the maximum amount a resident individual can borrow from a non-resident relative in USD or equivalent? Very nice question it is. Let's try to go through it. Option A says that $50,000. Option B says that $1 lakh, $2.5 lakh, $10 lakh, $5 lakh. What do you think? So first option say $50,000. You know, 50,000 is relatively a small amount compared to the FEMA actual limit, right? So suppose an NRI uncle want to help his nephew in India with a personal loan. He can send money more than $50,000 legally under FEMA regulation. Option C say that $1 lakh. So what do you think? Whether $1 lakh is correct? No. Although $1 lakh is a large amount, FEMA allow a resident individual to borrow even more from his NRI relative. So question is, how much Indian resident can borrow from his NRI relative, right? For example, if an Indian citizen want to borrow money from his NRI sister to start a business, then he can legally borrow more than $1 lakh. Option C says that $2.5 lakh. Yes, this is correct. You know, FEMA allow a resident individual in India to borrow up to USD $2.5 lakh from a non-resident relative. And you know about this loan, that this loan must be interest free. This loan must be interest free and have minimum tenure of 1 year. You should know about it. The borrowed amount can be used for personal or business purpose, but not for restricted activity like real estate investment or trading in prohibited sector. Right? You should remember it. For example, if an NRI father wants to lend USD $2 lakh to his son in India for higher education, he can do so under FEMA guideline, as the limit is $2.5 lakh. Is it clear? $10 lakh, which means $1 million, is not correct. It's too high compared to the FEMA set limit, and $5 lakh is also wrong. So you must remember what we learned from this question, that under FEMA, a resident individual can borrow up to US $2.5 lakh from a non-resident relative. So here the keyword is non-resident relative, right? And the loan must be interest free and have a minimum tenure of 1 year. It can be used for personal or business purpose except for restricted activity like real estate or stock trading. An amount higher than USD 2.5 lakh. The question says that what is the current maximum all-in cost ceiling per annum for ECB in foreign currency over the benchmark rate? Option A say 100 basis point, 250 basis point, 450 basis point and 550 basis point. And option E say, let me show you, as decided by the authorized dealer, that is AD. So friends, let's answer this particular question. So option A says 100 basis point. You know, when I talk about 100 basis point, it just means 1%. This is very low limit, right? Which would make it difficult for Indian borrower to attract foreign loan. Because in ECB what we do? We take loan from foreign buyer, right? So generally ECB borrowing costs are higher than just 1% of our benchmark rate. Let me give you an example. So if an Indian company wants to borrow, suppose USD 10 million. Suppose Indian company wants to borrow USD 10 million from a foreign bank, and the benchmark rate is suppose 4%. This is the benchmark rate. So 100 BPS cap would mean the maximum interest allowed is 5%, isn't it? So this is too low. A lender may not be willing to lend at such a small margin. Option B say 250 basis point. This is also not wrong. 250 means 2.5%, right? So while this is higher than 100 BPS, it is still lower than the actual RBI limit, right? So this might not be sufficient for high risk corporate borrower who usually borrow at higher rate. Now option C says that 450 basis point. This is also wrong, right? And suppose benchmark rate is 6%, then under a 450 BPS ceiling, the answer will be 10.5%. Option D says 500 basis point. Yes, this is correct, right? As per RBI guideline, the all-in cost ceiling for foreign currency ECB is 500 BPS above the benchmark rate. So this limit help balance affordability for borrower and attract foreign lender. You know, let's take an example. Suppose the SOFR benchmark rate is 5%. Then under 500 BPS ceiling, an Indian company can borrow at a maximum rate of 10%. How 10% come? 5% is the benchmark plus 5% is the extra, right? So 10%. So RBI allow a maximum ceiling of 500 BPS for foreign currency ECB. Option E say as decided by the authorized dealer. This is not correct, because authorized dealer are banks that handle forex transaction, right? But they do not decide the ECB cost ceiling. RBI set the limit and AD must ensure compliance. For example, a company cannot negotiate an ECB loan at rate they want. It must follow RBI 500 BPS limit. So what we learned from this question, that RBI set the maximum all-in cost ceiling for foreign currency ECB at 500 basis point above the benchmark rate. This ensures that, let me show you the writing. So what is the correct answer? Option number D, right? So what we have learned is that 500 BPS is allowed by RBI, and the benchmark rate should be SOFR. What is SOFR? You know, right? SOFR, LIBOR. It can be SOFR, it can be LIBOR, or it can be any approved rate, right? And authorized dealer do not decide this limit. RBI does decide this limit, right? And the ceiling is reviewed periodically based on economic condition. I hope this make your concept clear. Now let's move to the next question. right? So the question is, the foreign tourist visiting India wants to open a bank account for managing local expense. Which account is permitted? NRE saving account, NRO saving account, regular saving account, only a current account, no account can be opened. So what is your answer? So the correct, let me show you the option. First option say NRE saving account. Let's talk about it. NRE saving account, that is a non-resident external saving account. So it is for non-resident Indian. This is for NRI who wants to earn income, who earn income from abroad and want to park their foreign earning in India. Foreign tourists are not NRI. A foreign tourist is not an NRI, right? They are just visitor for a short time, so they are not eligible to open NRE account. Imagine John from USA, right? He is visit India for tourism. He earned his salary in US dollar and does not have any income in India. So John cannot open NRE account because it is only for NRI who earn outside India and want to deposit in India. Option B says that NRO saving account. So this is the correct answer. NRO account is meant for foreigner who have earning or need to manage fund in India. That foreign tourist can deposit foreign currency which is converted to INR and it is used for local expense. However, there are restrictions on how much money can be sent back to their home country. Let's say John from Canada, right? He is traveling in India in 2 months. So he wants a local bank account to handle his expense. So he can open an NRO account depositing Canadian dollar, that is CAD, and withdraw money in Indian rupees for travel and shopping. Right, so that is why option number B is correct. Rupee saving account, this is not correct because rupee saving account is only for Indian resident. A foreign tourist is not a resident, so they are not allowed to open this type of account. Only a current account, this is also not correct. Current account are mainly for business, not individual, right? A foreign tourist does not need a current account. And option is that no account can be opened. This is wrong because foreign tourists cannot open any account. This is wrong. They can open an NRO account. So what we learned from this particular question, just let me summarize the fact. The fact is here that foreign tourists can open NRO saving account in India. NRE account are only for NRI, not for tourist. Regular saving account are for Indian ex-resident. A current account is not needed for tourist, and tourists can deposit foreign currency in an NRO account, but repatriation limit apply. They cannot repatriate the entire fund. There are limit on how much the fund they can repatriate. Now, very nice question. The next question is, what is the maximum amount of Indian rupees that a person from Nepal or Bhutan can bring into India? Very good question. So option A says 5,000 rupees. While this might seems like a reasonable limit, it is not the correct answer. There is no restriction where only 5,000 rupees is allowed for people traveling from Nepal and Bhutan. The correct rule is slightly different. So imagine Sita from Nepal is traveling to India. She thinks the limit is rupees 5,000, but when she reaches the border, she is told that she can bring in more as long as it is in the right denomination. Option B says 10,000. This is also incorrect. Option C says that 25,000. This is also incorrect. Option D says that any amount in the denomination of 100. Yes, correct. According to the RBI guideline, any people traveling from Nepal and Bhutan can bring Indian rupees into India without a specific overall limit, but it should be only in denomination of rupees 100. Higher denomination note like 200, 500 or 2000 are obviously 2000 not there. 200, 500 are not allowed. Right. So this helps regulate currency movement and prevent misuse of large denomination in cross-border transaction. Right. That is the point. And option E says 50,000. This is also wrong. Now let's see the next question. In banking terms, how is side bill under import letter of credit classified? How do you classify a side bill under import letter of credit? So this question pertains to the letter of credit. So friends, option A says that AE&D, LCBR, IDBE, IUBF, and option E says that DBUF. So let's start with A&D, that is acceptance and endorsement. This refers to a process where bank accepts a bill of exchange and endorses it for further processing. So A&D means acceptance and endorsement. It is a process where the bank accepts a BOE. So this is the bank. It accepts something called bill of exchange, and what it does, it endorses it for further processing. This is typically used for documents that require approval from payment over time, not for immediate payment. For example, John, a business owner, needs to pay for goods he is importing. If his bank accepts the bill, this would fall under acceptance and endorsement, but not when it comes to a side bill. So this is not the correct classification for a side bill because we are talking about side bill here. Option B say LCBR, which is letter of credit bill register. LCBR is the correct classification of side bill under LC. Side bill, what is the meaning of side bill? The meaning of side bill? It means that payment is required immediately upon presentation of the document. Once I present document, give me payment. That is the exact definition of the side bill, right? So the bank accept a letter of credit bill register to track all these transactions and ensure that payment is made on time. So basically this LCBR is what? It is a kind of reporting. It is a place to track all these transactions. For example, let me give you example of LCBR. For example, Sarah, right? Sarah, he is an importer from India, is buying machinery from Germany. She present the side bill to her bank. So she is Indian. So she is importer from India, and she is buying machinery from where? Germany, right? So what she does, she present the side bill to her bank. So suppose this is the SBI bank. She went to the bank and she presented the side bill. She presented the side bill to the bank, that is SBI. So bank will record in the LCBR, which is the letter of credit bill register. Bank will make sure that payment is done immediately once the required documents are presented. So that is why option number B is the correct answer. IDBE. IDBE is incorrect, which is import document bill for export. Bill for export. It refers to the export related document. It is not used in the case of side bill under import letter of credit. So option D says IUBF, which is import usance bill finance. This is also incorrect. This is opposite to the side bill, where payment is due immediately when the documents are presented. Side B are not related to the time based financing, so this option is not relevant. And option E says, let me show you the option E also. Just wait a minute. Why I am telling each and every option, because sometimes question may be asked from option number C, option number D, so you must know it. Option number E says that demand under bill finance, demand bill under finance, that is DBUF. You know that it refers to the demand bill that are financed by the bank, often used when the payment is due on demand with the bank financing. When this could sound similar to a side bill, it is different process because it involves financing by the bank. Let me give you an example. Suppose take an example of Tom. Tom is a person, right? I am talking about DBUF. Let us make you understand. Tom has to make immediate payment for goods, but the bank does not need to finance it. Since the payment is required right away, this is not a DBUF, but rather fall under the letter of credit bill register. So what is the key takeaway, what we have learned from this particular question? Let me show you. We have learned that the side bill is required immediate payment upon presentation. You can see clearly written here. It requires immediate payment upon presentation of document, and it is recorded and tracked under the LCBR, which is letter of credit bill register. You must know it. And other options like acceptance and endorsement, import usance bill finance, demand bill under finance does not apply to the side bill because they either involve time based payment or financing. I hope this make your concept crystal clear now. Right, now let's move to the next question, that is question number 3. I hope it is. So let's see what is question C. So the question says that as per international trade regulation, within how many days should bank examine document under letter of credit? So option A say within 3 working days. Not correct, because according to the international trade rule, the time frame for bank to examine LC document is not 3 working days. Option B say 2 days. Not correct. Option C say 5 banking day. Correct. So according to the UCP 600, Uniform Custom Practice 600, which governs the international trade practice, bank must examine the document under a letter of credit within 5 banking day. Right, let me give you an example. So suppose Tom is a business owner, has its goods shipped to India. When the bank receives the document, it has 5 banking day. 5 banking day, this is keyword. It has 5 banking day, right? Bank has 5 banking day to verify if everything matches the letter of credit terms. If there is an issue, the bank notify Tom in time for him to address it, right? So that is why option number C is correct. No need to see other option because we know what is the correct answer. Now let's see the next question. Which bank is responsible for making the credit available to the beneficiary under letter of credit? So let's answer this question. Option A say confirming bank. Not correct. Confirming bank is a bank that add its own confirmation to the LC, guaranteeing payment to the beneficiary in addition to the issuing bank. However, it is not the only one directly responsible for making the credit available under the LC. In simple terms, what is confirming bank? Confirming bank provide an extra layer of security by assuring payment, but they are not the one who actually made the payment, right? So confirming bank is wrong answer. For example, let's take an example of a person. Let's say Ram, right? Ram is a seller. He has goods shipped. And his buyer confirmed the payment guarantee. While the confirming bank gives security, the actual payment comes from another source. Now, the question is who is even making the credit available to the beneficiary? Option B is a beneficiary bank. This is not correct. Beneficiary bank is the bank where the exporter holds their account. It does not handle the making of credit available directly. Rather, beneficiary bank helps the beneficiary by advising and forwarding the document to the other bank involved. So let's take for example Syam. So Syam is a beneficiary and his bank will receive the document, but the bank is not responsible for making the credit available to him. Ram need to rely on other bank for payment process. Let's see the option number C. Option number C says, just wait a minute, buyer's bank. So buyer's bank is also called the issuing bank. is the bank of the buyer that issues the letter of credit. While the buyer bank plays a central role in the LC, it does not directly make the payment available to the beneficiary. The buyer bank guarantees the payment but does not directly make the payment available under the LC. Now option D is a nominated bank. Correct. This is the correct answer. You know that nominated bank is the correct answer. This is the bank that is specifically mentioned in the letter of credit. It is the bank authorized to make the payment to the beneficiary upon receiving compliant document. For example, let's take an example of Sita. So Sita, a seller, she presents document to the nominated bank as per the LC term. The nominated bank checks the document and makes payment available to Sita once everything is in order. That is why option number D is the correct answer. Option number E say advising bank. This is not correct. Advising bank is the bank that advises the exporter of the LC, while the advising bank confirms the authenticity of the LC and communicates the detail to the beneficiary. It does not make the credit available to them. For example, John is an exporter, receive an LC from his bank. The advising bank informs John that the LC has been issued, but it does not actually pay him. So this question is regarding the payment. So what we learned from this particular question, let us summarize the fact, because you know each and every bank is super important, right? So what we learned is that nominated bank is the bank responsible for making the credit available to the beneficiary. The bank may be advising bank or another authorized bank as specified in LC. While other banks like buyer bank, confirming bank, advising bank play important role, the nominated bank is the one that ensures payment is made to the beneficiary. This is the point which we learned now. Now let's see the next question. In case of PCFC, that is question say that in case of PCFC, that is pre-shipment credit in foreign currency account, how is the monthly interest collected from the borrower? So option A says that from the current account, option B says from cash credit account, option C says from the saving bank account, option D say by the sale of foreign currency, option E say from the FCNRB account. So let's see, analyze each and every option. So the current account is typically used for day-to-day banking transaction like deposit and withdrawal. However, when it's come to the collection of monthly interest on PCFC, the interest is not collected from the standard current account, right? Option B says from cash credit account. So this is also not correct. CC is an account often used by business for working capital need and can be in Indian rupees or foreign currency. However, just like the current account, CC is not the primary account used for collecting the monthly interest on PCFC, right? So imagine you have a cash credit account where you borrow money for your business operation, but this is not the account where foreign currency interest will be collected. From the saving account. Saving account is typically used for personal saving, and while it may earn interest on deposit, it is not used to collect interest in PCFC. And option D says that by the sale of foreign currency or debit to the EFC account. Yes, it is correct. You know, when a business receives PCFC, the monthly interest is collected by either first option is sale of the foreign currency or debit to the EFC account, that is debiting the exporter exchange earner foreign currency account. So this method is used to avoid the complication of exchange rate fluctuation while paying interest on the foreign currency account. So let us take an example and make this concept more clear. So what is happening, let's say you are an exporter and you have a foreign currency loan for your shipment. When the loan interest is due, the interest amount is collected by converting the foreign currency you have earned through your export or by deducting it from your EFC account. So what I am telling you, you are an exporter, right? And you have a foreign currency loan. You have taken a foreign currency loan, so for your shipment. When the loan interest is due, the interest amount is collected by converting the foreign currency you have earned. Since you have exported, so you will get foreign currency. So either that foreign currency will be converted by deducting it from the EFC account, exchange earner foreign currency account. And option E says FCNRB account. This is also incorrect, because although it is a type of foreign currency account, but it is typically used by NRI to hold their foreign currency deposit, right? So that is the point. So you may have FCNRB account, but if you are an NRI, but that is not the account used for collecting interest on pre-shipment credit. So what we have learned in this particular question, the key point is that PCFC, the monthly interest on PCFC is collected by either by selling the foreign currency, right, or by debiting the EFC account. I hope this makes your concept crystal clear now. Let's move to the next question. A foreign student studying in India must provide a local address declaration within how many days of opening an account? Very good question, right? So option A says 7 days, option B says 15, 30 days, 6 months or 3 months. So 7 days is not correct, right? Imagine you are a foreign student arriving in India and opening a bank account. If you have to provide your address within 7 days, it might be too soon, right? 15 days is also not correct. Right, 30 days is correct. According to RBI regulation, if foreign student is required to provide their local address declaration within 30 days of opening a bank account. This rule helps bank ensure that they have the correct contact information for the student and can track their residential status. So the correct answer is 30 days. You must remember it, right? So this is the key takeaway. As per the RBI regulation, a foreign student in India must provide their obviously I told you earlier that they are allowed to operate an RO account, and they must submit their local address proof within 13 days. And if the local address is not provided within this time frame, transaction may be restricted until its compliance is met. So these are the points you need to cover. Now, let's see the next question. What is the standard period within which post shipment credit, that is bill purchase or bill discounted, should be realized? Right, very good question it is. So option A says that 3 months, 6 months, 9 months, 12 months, 3 years. 3-month period is not enough for post shipment credit to be realized. Exporter are allowed a longer time. Imagine you are an exporter selling product to a company overseas. Even though the goods were shipped, the buyer might need more time than 3 months to settle the payment. 6 months is also not correct. 9 months is correct, right? According to the RBI and FEMA guideline, export bills will be generally be realized within 9 months from the date of shipment. If the payment is not received within this time, exporter must seek approval or report the delay to the bank or RBI. Suppose you have shipped a large order of goods to a foreign customer, right? So there is a foreign customer and you have shipped a large order of goods. So you have up to 9 months to receive payment. If the customer has not paid by then, you will need to get a special approval from the bank or RBI to continue the process. You can see question number 3 on your screen. So friends, so in this question we have this is the MCQ based on how import bill work under LC. So the question is, an import bill under letter of credit is received by the LC opening bank on 1st March as demand bill. So it has been, the main point has been darkened, right, highlighted. When it will be crystallized into rupee liability if 10th March is a Sunday or holiday, right? Option A, 9th March, 10th March, 11th March, 12th March. Take a moment to think about it. So option number A, 9th March. This option says that bill will be crystallized on 9th March. However, the rule is that demand bill are crystallized on the 10th day. What is the rule? That demand bill. So this is the demand bill, and you know, demand bill are crystallized on 10th day, right? It is crystallized on 10th day from where they are received. So this does not fit. Option number B, 10th March. So this option suggests that it is 10th March. While this is technically the 10th day, 10th March is a Sunday, right? You can see 10th March is a Sunday clearly written. So which means it is holiday. According to the rule, if the 10th day fall on holiday, the bill is not crystallized on that day. So this is also wrong. Now let's see option number C. Option number C says 11th March. Remember, if 10th day fall on holiday, the bill is crystallized on the next working day. So since 10th March is Sunday, the next working day is Monday, 11th March. So this fit perfectly with the rule. And 12th March, this is wrong, because you know 11th March is the next working day after the holiday. There is no need to wait till 12th March. So the correct answer to this question is option number C, 10th March, 11th March, right? Because it is the next working day after the holiday. So here are some key points to remember. That you must remember that demand bill are crystallized on the 10th day from where they are received. This is the main thing that you have to remember. Second point is that if the 10th day fall on holiday or Saturday, the bill is crystallized on the next working day. So if you enjoyed this explanation, don't forget to hit the like button. And friends, if you are looking for a study material for foreign exchange, because you know we have added 3 to 4 separate previous year question paper on our course. So there is a course on foreign exchange, right, in which you get unit wise theory PDF, unit wise MCQs PDF, and previous year question, memory based question, which have been collected from the students who have given the examination, right? The course link is provided in the description, or you may WhatsApp me on this particular number is shown on the screen, to get more detail regarding the course, right? Because this course has a huge success ratio, because most of the people who have enrolled in the course, which only cost rupees 200, they have successfully cleared the examination in their very first attempt. So if you are looking for it, you can just WhatsApp me on this particular number. Now let's continue our discussion with our next question, which says that which of the following statement is correct regarding the reimbursement timeline under LC and export to Russia? Very good question it is. Let's answer it. So basically options are: export to Russia if reimbursed by RBI must be settled within 15 days. Option B, if an LC allow reimbursement by electronic means, the claim, so question is which is correct, right? If an LC allow reimbursement by electronic means, the claim must be made within 10 days. Option number C, if LC provide TT reimbursement, the claim must be made within 5 days. Option D, if an LC allow reimbursement after a negotiation period, the claim must be made within 5 days plus additional specified day. Take a moment to think about it. Which option is correct has been asked. Great. I hope you got your answer. Now let's break it down. Option number A, export to Russia settle in 15 days. So what do you think? So however, it says that this option says that export to Russia reimbursed by RBI must be settled within 15 days. However, the actual rule is that such reimbursement must be settled within 20 days, not 15 days. Right? So this is wrong. Then option number B suggests that if an LC allow reimbursement by electronic mean, the claim must be made within 10 days. Right? So, but this is incorrect because reimbursement through TT. What is the meaning of TT? Telegraphic transfer. Reimbursement through TT or similar method must be claimed within 5 days. You must remember it must be claimed within 5 days, not 10 days. Option number C says that TT reimbursement in 5 days. So this option says that TT reimbursement under an LC letter of credit must be claimed within 5 days. See, it is written. But while this is correct for TT reimbursement, specifically it does not cover all scenario like those involving negotiation period. There are some scenario which involve negotiation period, right? So those scenario which involve negotiation period, in that case it does not fit well. So while partially correct, it is not the most complete answer. Right. So again I am repeating, this option number C suggests that TT reimbursement under LC must be claimed within 5 days. This is correct for TT reimbursement. It does not cover all scenario like those involving negotiation period. And option number D says that if LC allow reimbursement after a negotiation period, the claim must be made within 5 days plus additional specified day. This is correct because when a negotiation period is involved, so here the key point is negotiation period. Whenever the negotiation period is involved, those extra specified day to the standard 5-day timeline for making claims, right? So there are some 5 day plus additional specified day. This is the key point, right? So this make option D the most accurate and comprehensive answer. So the correct answer is option number D. So what we learned from this question, let me summarize the fact a little bit. So our learning is that so this is the explanation part. So our learning is that reimbursement for export to Russia via RBI must follow a timeline of 20 days, right? This is the first point. Second point is that reimbursement claim via TT or electronic mean must be generally be made within 5 days. And the third option is that if there is a negotiation period in an LC letter of credit, you add those extra specified day to the 5-day timeline, right? So remember these 3 points, super important, right? Now let's switch our focus to our next question. The next question you can see on your screen. It says that so friends, this question is about interbank Vostro transfer via RTGS and the submission of Form A3. Which of the following statement is correct regarding interbank Vostro transfer via RTGS and Form A3 submission? Option number A, the remitting bank must mention in RTGS message, we undertake to send Form A3 separately. Option number B, the beneficiary bank must receive Form A3 within 10 working days or a penalty is imposed. Option number C, if the beneficiary bank does not receive Form A3 within 5 working days, it must lodge a claim within 15 days from the date of fund transfer. Option number D, the remitting bank must ensure Form A3 reaches the beneficiary bank within 30 days of the transfer. These are the 4 options. So, so friends, the 4 options have been given. Take a moment to think about it. Right, take a moment to think about this question. Got your answer? Let's break it down. Option number A suggests that sorry friends. So option number A suggests that it says that remitting bank must include a remark in RTGS message, we undertake to send Form A3 separately. This is actually correct. As per FEDI rule, FEDI, Foreign Exchange Dealer Association of India, as per FEDI rule, right, this rule is correct, but it is not the most comprehensive answer because it does not address timeline or penalty, right? That's why this is not the comprehensive answer. Option number B, right, it states that Form A3 must reach the beneficiary bank within 10 working days or a penalty is imposed. This is incorrect because the actual rule is that Form A3 must be submitted within 5 working days, not 10 working days, right? So this is wrong. Now let's see option number C. So question is which is correct, right? Which is correct. Now option number C says that this is also it says that if the beneficiary bank does not receive the Form A3 within 5 working days, it must lodge a claim with the remitting bank within 15 days from the date of fund transfer. That is what it is saying. This is absolutely correct. It covers both the 5-day submission deadline and what happens if there is a delay. Very important. So you can see 5-day submission deadline is there
right, for Form A3, and also it must lodge a claim within 15 days from the date of fund. Two things have been covered here. This is the correct answer. And option D says that the remitting bank has 30 days to send Form A3. This is incorrect because no such 30-day rule exists for the Form A3 submission. So the correct answer to this question is option number C. So here are some key points to remember. You must remember is that the remitting bank, right, must include a remark in RTGS. It must include a remark in RTGS message about sending Form A3 separately. Form A3 must reach the beneficiary bank within 5 working days or penalty will apply. And if there is a delay, the beneficiary bank has 15 days from the transfer date to lodge a claim. So see what is happening here. The two banks are there. One is remitting bank, other is the beneficiary bank. Someone is receiving, someone is giving. That's it, right? So the remitting bank must send a message that we undertake to send Form A3 separately, right? And beneficiary bank must receive Form A3 within 5 working days or a penalty is imposed. And if it does not receive Form A3 within 5 working days, it must lodge a claim within 15 working days. So these are the timeline which you must, and question on timeline are very frequently asked in examination. You must note it down. Now this is a very good question. The next question we have, as you can see on your screen. So it is related to, which of the following is not a permissible capital account transaction, right, by an individual under LRS. LRS, it's called liberalized remittance scheme. So which is not a permissible. So please read it carefully. Not a permissible. Most of the time we ignore this word, right? So let's see the option number A. Opening a foreign currency account abroad with a bank, acquiring immovable property abroad, making ODI, that is overseas direct investment, and OPI, that is overseas portfolio investment. And option number D suggests that giving loan in Indian rupees to any non-resident India, that is NRI. So these are the 4 options. Take a moment to think about it. Got your answer? Let's break it down. So option number A, opening a foreign currency account with, so this option states that this option is correct under LRS, opening a foreign account abroad with a bank, because individuals are allowed to open and maintain foreign currency account with bank abroad for various transactions like investment or property purchase. Option number B suggests acquiring immovable property abroad. This option is also correct because LRS permit individual to invest in overseas business or financial asset like share and mutual fund. Option number C, making overseas direct investment and OPI. So this is where the rule get specific. This option is also correct. LRS permit individual to invest in overseas business or financial asset like shares and mutual fund. And option number D, giving loan Indian rupees to any NRI. Yes, this is where the rule gets specific. Loan can only be extended to NRI who are relative. So only those NRI who are relative, only to them loan can be extended, right, as defined under the Companies Act. So relative must be defined under the Companies Act, and those relative only loan can be extended. Giving loan to any NRI who is not relative is not allowed under LRS, making this the correct answer for what is not permissible, right? So the correct answer is option number D, right, but this is not permissible. So let's summarize. There are some key points which you must keep in mind. Some question can be asked regarding not a capital account transaction. So LRS allow capital account transaction like opening foreign currency account, buying property, making investment abroad. Loan under LRS can only be given to NRI who are relative as per the Companies Act. Always check a specific condition before making transaction under LRS. So this was the explanation. I hope this makes sense to you. This is quite clear to you. Don't forget to hit the like button so that most other aspirant also get help of such kind of videos. Now let us switch our focus and let's see the next question that we have. Here is the question you have. Which of the following statement about ODI? What is ODI? Overseas direct investment is correct. Which statement regarding ODI is correct? Option number A, ODI and FDI are same since both involve cross-border investment. Option number B, ODI occur when a resident company invests in WOS. WOS, wholly owned subsidiary or joint venture in a foreign country. Option number C, country with high ODI usually have weaker economy and less investment competitiveness. Option number D, emerging market receive less ODI due to slower growth rate. So take a moment to think about it. Got your answer? Let's break it down. Option number A suggests that ODI and FDI are same. What do you think? So this is because both involve cross-border investment. However, this is incorrect. Which is correct is I asked. Because FDI refers to when a foreign company invests in other country, right? So suppose when a foreign company, suppose Microsoft. So Microsoft invest in India, right? So this is a kind of FDI, foreign direct investment. But what is ODI? ODI is when a resident entity like an Indian company, for example Infosys, right, when a resident company, right, So whenever ODI, okay, so what is ODI? ODI happen when a resident company, right, invest abroad. Like suppose Infosys is investing in US, so this is called ODI, right? This is called ODI, right? So there are two different direction of investment, they are not same. Now option number B, ODI occur when resident company invest in wholly owned subsidiary or joint venture in the foreign country. This option states that ODI occur when a resident company invests in WS or JV in foreign country. This is correct because ODI allow, right, companies to expand their operation by setting up or investing in business abroad. Option number C, country with high ODI usually have weaker economy and less investment competitiveness. Right, this option claims that country with high ODI have weaker economy. This is incorrect. A high level of ODI usually indicate a strong and competitive economy because it shows the company has the resources and confidence to invest abroad. This is wrong. Option number D, emerging market receive less ODI due to slower growth rate. So what do you think? Is it correct? This is wrong. This is also incorrect because emerging market often attract more ODI because they offer rapid growth opportunity. If the market is emerging, right, so they offer rapid growth opportunity, right? They offer rapid growth opportunity, making them attractive for investment. So the correct answer to this question is option number B. So here are some key points to remember. The first point is that ODI involve a resident entity investing in a foreign company, unlike FDI, which is the reverse, right? High ODI level typically indicates a strong economy with competitive business. Emerging market often attract more ODI due to their growth potential. So I hope this makes sense to you. I hope the difference is quite clear. What is ODI? What is FDI? What is the difference? Now let us see one more question related to ODI. Very good question it is. Let's answer it. Question is, which of the following statement regarding ODI is correct? Okay. Option number A, under automatic route, Indian company require prior approval for all overseas investment. Option B, if an Indian company does not meet the condition of automatic route, it must seek RBI approval under the approval route. Option number C, resident individual can invest in joint venture or wholly owned subsidiary abroad, but only up to $5 lakh per financial year under the LRS. And let's see option number D. Question which is correct have been asked. Option number D, resident individual investing under LRS can write off their investment income if they fail to repatriate it within 60 days. So let's go through each and every option. First of all, you think yourself what is the correct answer. So this option is suggests that Indian company need prior RBI approval for all investment under the automatic route. This is incorrect because under the automatic route, company don't need prior RBI approval as long as they meet certain condition, such as, what is the condition, such as for staying within the 400% of their net worth. If they stay within the 400% of their net worth, they do not require any permission from RBI or RBI approval. So this option is wrong. Option number B suggests that if the Indian company does not meet the condition of automatic route, it must apply under approval route. This is correct. Under automatic route, proposals are scrutinized by the authorized dealer bank and forwarded to RBI for approval. So see, this ODI company, first of all, they send their application to AD, and then further this AD scrutinize the application form and then send it further to RBI, right? So this make option B the right answer. If it is so, see, obviously if the condition does not meet for the automatic route, so they will apply under approval route. There are two kind of routes are there. Option number C claims that resident individual can invest up to $5 lakh per financial year under LRS. This is completely incorrect because the maximum limit is $2,50,000 under LRS. That's it per financial year. Okay, and let's go through the option number D. Option number D, what it suggests? It says that option D claims that resident individual can write off their investment income if they fail to repatriate it within 60 days. This is false because FEMA guideline require individual to repatriate income earned from investment within 60 days and not this, not within 60 days. And not no write off is allowed. Write off cannot be done, right? Cannot write off. So this write off word is wrong. And they can, if they fail to repatriate, right? So FEMA guideline requires individual to repatriate income earned from investment within 60 days. So the correct answer is option number B. So what we learned, say here are some key points which you must keep in mind, right? First thing is that the automatic route, right? The automatic route allow ODI without prior RBI approval if the condition like staying within 400% of their net worth are met. And the approval route applies when the conditions are not met or for restricted sector like real estate or banking. Under LRS, resident individual can invest up to $2,50,000 per financial year. I hope this makes sense to you. Now let's see one more question, that which of the following is not allowed under LRS, but which is prohibited under LRS. This question is most frequently asked. What are things prohibited under LRS? So option number A suggests right, that remittance for purchasing FCCB. You know what is FCCB? Foreign currency convertible bond issued by Indian company in the overseas secondary market. Option number B, remittance for personal travel, medical treatment, education abroad. Option number C, sending money abroad for margin call on overseas exchange. Option number D, remitting fund to a country identified as FATF. You know FATF, recognized as non-cooperative jurisdiction by FATF, that is Financial Action Task Force. So what do you think? What do you think is the correct answer here? So friends, let's take a moment to think about it. So option number A suggests purchasing an FCCB, right? Which is foreign currency convertible bond. This option is correct because purchasing this FCCB, purchasing FCCB issued by Indian company in overseas secondary market is not allowed under LRS. So question is, which is not allowed under LRS? Yes, this is correct. It's not allowed under LRS, right? It is one of the specific restrictions mentioned in the RBI guideline. Option number B, personal travel, medical treatment, education abroad. So this option is incorrect because LRS allow remittance for personal travel, medical treatment and education abroad. So that's why this option is incorrect. Option number C, sending money for margin call or overseas exchange. This option is correct because sending money abroad for margin trading or margin call or overseas exchange is prohibited under LRS. Is prohibited under LRS, right? So this is correct. And option number D, remitting fund to a country identified as non-cooperative jurisdiction. So this option is also correct because LRS prohibits remittance to country identified as non-cooperative jurisdiction, right? So these countries are flagged due to financial risk like money laundering or terrorism financing. So the correct answer to this question is option number A, right? So what we learned from this question is that LRS allow remittance for personal purpose like travel, education, medical treatment. Some prohibited transactions include purchasing FCCB in foreign market, margin trading on overseas exchange, remittance to FATF, non-cooperative jurisdiction. So we must always check RBI guideline before making international remittance. That's the point. Now let's see the next question. Which of the following, just wait a minute. So which of the following statement about DDA is correct? DDA, diamond dollar account. That is the point. So option number A suggests that DDA is a saving account for exporter in the gems and jewelry sector, earning interest on deposit. Option B suggests only firm engaged in gold trading can open a DDA. Option C suggests that DDA is a current account in US dollar meant for gems and jewelry export with no interest paid. And option D suggests that firm without any prior export import experience in diamond or jewelry can open a DDA immediately. What do you think? What is correct about DDA? So let's go through option by option. Option A suggests that, first of all, talk about option number A. Option number A suggests that DDA is a saving account. So where exporter earn interest on deposit. This is incorrect because DDR is strictly current account. This DDA is not a saving account. DDR is strictly the current account, right? And no interest is paid on balance held in this account. You know it very well. Only firm engaged in gold trading can open a DDA. This is incorrect because DDR is specifically for firm dealing in rough, cut or polished diamond. Because name itself suggests diamond dollar account. So either it is rough, either it is cut, or either it is polished diamond, right? Option C says that DDA is a current account in US dollar with no interest paid. This is correct because DDA is a non-interest bearing current account maintained in dollar, because that's why in the name you will see dollar account. So it is maintained in US dollar, right? Created for exporter in the gems and jewelry sector. It allows them to transact directly in dollar without converting fund into Indian rupees. Option number D, firm without any prior export import experience in diamond can open. This is wrong. They require 2 years of good track record. 2 years of good track record, right? Because no firm with no experience cannot open, right? Because firm must have at least 2 years, at least 2 years of good track record in exporting and importing diamond or jewelry. Then only they can open this DDA account. You must remember this condition, right? So let's summarize once more. So let's summarize the point which we have learned in this question. The first point is that that DDA is a current account in US dollar. First point, that it is a non-interest bearing current account in US dollar. You can see non-interest bearing current account in US dollar. it is available to exporter dealing in diamond and precious metal jewelry who meet eligibility criteria like having at least 2 years of export-import experience. And DDA help exporter avoid currency conversion cost by allowing direct dollar transaction. So currency conversion cost get reduced. That is the main advantage of DDA. So now let's see the next question. Which of the following statements regarding the purchase or sale of immovable property in India by foreign entity is correct? Right. So let's go through the option. Option number A, foreign embassies and diplomat can buy immovable property in India without any government clearance. Option number B says that citizens of Pakistan, Bangladesh, Sri Lanka, Afghanistan, China, Iran, Nepal can freely purchase immovable property in India. Option number C, foreign embassy, diplomats and consultancies must obtain clearance from Ministry of External Affairs before buying, selling property in India. And OCI, overseas citizen of India, are also restricted from purchasing immovable property in India. So this question were exactly as it is asked in the examination. So let us answer this particular question. So which is the correct one? So friends, option number A is incorrect, because foreign embassy, diplomat and consultant cannot freely buy or sell property in India. They must get clearance from the MEA. So this is incorrect. Option number B, this option is also incorrect, because citizens of this country like Pakistan, Bangladesh, Sri Lanka, Afghanistan, China, right, they cannot acquire or transfer immovable property in India without prior approval from RBI. They must take prior approval from RBI, right? So here the key point is that RBI approval is very much required. The third option is I think it is correct, because they must get clearance from MEA, that is Ministry of External Affairs, right, before buying property. That is the point. And option number D is that OCI is also restricted from purchasing immovable property in India. So this option is incorrect, because OCI are allowed to purchase immovable property in India except for agricultural land. So you must know some exception, that except for agricultural land, they can't buy agricultural land, right? Or we can say plantation property. So suppose some plantation property is there, also they can't buy that, or farmhouse. So these are the three restrictions for OCI. But rest thing they can buy, rest immovable property they can buy, right? But they can't buy agricultural land, they can't buy plantation farm, or they also can't buy this farmhouse. So these three are the main important restrictions which you must keep in mind. Now let's see our next point. The next question is, which of the following regarding NRI loan scheme for purchasing share under ESOP scheme is correct? Correct, remember it, correct is asked. Option number A says that the maximum loan amount that can be availed is 50 lakh. Option number B, the employee must have a demat account to be eligible for the loan. Partially paid share are eligible for finance under this scheme. And option number D, that the loan tenure is 60 months and repayment is through a lump sum at the end of tenure. So which of the following statement regarding NRI loan scheme for purchasing share under the ESOP is correct? This is the question, right? So let's go through each and every option. Option number A, maximum loan amount that can be availed is 50 lakh. This is incorrect, because the maximum loan amount allowed under the scheme is rupees 20 lakh, right? And or we can say either 20 lakh or 90% of the purchase price of the share. So either you say it 20 lakh or you say it 90% of the, let me write it down, 90% of the purchase price of share, 90% of the purchase price of share, either of them, right? Either 20 lakh or 90% of the purchase price of the share. So this option is incorrect. Option number B says that demat account is mandatory for eligibility. So this option is correct. To participate in ESOP, that is employee stock option purchase, so this and avail, so to participate in an ESOP and avail of loan, NRI must have a valid NRI demat account, right? So this is correct. Option number C, partially paid up share are eligible for finance under this scheme. This option is incorrect, because only fully paid share, not partially, only fully paid share, right? Only fully paid share are eligible for financing under the ESOP loan scheme. And what about option number D? What does option number D suggest? That loan tenure is 60 months. So this is also incorrect, because the actual loan tenure under the scheme is 36 months, not 60 months, right? 36 months, right? And and repayment must be made in EMI. EMI, that is equated monthly installment, not as a lump sum. So what are the important points to remember? Let me summarize the fact. So the important point to remember is that the maximum loan amount for NRI under ESOP loan is either 20 lakh, right, or 90% of the purchase price, whichever is lower. So either you call it 20 lakh or 90% of purchase price of share, whichever is lower, right? A valid NRI demat account is mandatory for participating in ESOP and availing loan. Only full paid share, right, are eligible for financing under this scheme. And the loan tenure is 35 months with repayment in EMI. You must remember this point, very very important for participating in ESOP. Now let's move to the next question. The next question is, friends, if this video have been helpful till now, please hit the like button. This will motivate me to make more such and such content, right? So let's see the next question that we have. The question says that a person bringing foreign currency into India is required to submit a CDR, that is currency declaration form, at the airport if, right? Option number A, that if the total foreign exchange exceed USD 10,000 or its equivalent. Option number B, the cash portion exceed 5,000 or equivalent. Option number C, both A and B, right? And option number D, it says that no declaration is required regardless of the amount. Option number A is partially correct, because this is suppose India, right? If you are bringing money, whether it is in the form of cash, whether in the form of traveler check, or whether it is in the form of bank draft, so if it exceed USD 10,000, if it exceed USD 10,000 or its equivalent, you must declare it in the currency declaration form. So this option is partially correct, right? So option number B, let's see option number B. It says that US cash portion exceed 5,000. Yes, this option is also partially correct. If the cash portion alone, which foreign currency notes, if the cash portion or foreign currency note alone exceeds $5,000, so you need to declare it. Option number C satisfies both the condition, and it is the correct answer. You must submit a currency declaration form if either of these conditions is met. The total foreign exchange exceed $10,000 or cash portion exceed $5,000. This ensures transparency and compliance with the RBI regulation. Option number D is wrong. It says no declaration is required. No, this is incorrect. So what is the key points which you must keep in mind? That if the total foreign exchange exceed $10,000 or its equivalent, you must declare it. And if the cash portion alone exceeds $5,000 or its equivalent, you must declare it. And always submit a currency declaration form if either of these limit is breached, right? Now, which of the following statement describe the state bill of lading? This is the question regarding state bill of lading. Sorry, not landing, state bill of lading. So let's go through each and every option. Option number A suggests that it is a negotiable document that allow the transfer of ownership of goods during transit. Option number B, it requires the carrier to deliver goods only to a specific named consignee. Option number C, it permits the consignee to endorse the document to another party. Option number D, it is primarily used when goods are shipped without prior payment by the buyer. So option number A, it says that negotiable document. So we are talking about a straight, let me write down, a straight bill of lading, right? So this option is incorrect, because state bill of lading is a non-negotiable document. It's not a negotiable, it is a non-negotiable document. It does not allow the transfer of ownership during transit. You cannot transfer the ownership. Negotiable bill of lading, like those used in letter of credit transactions, serve this purpose, right? So option number A is incorrect, because the state bill of lading is a non-negotiable document. Option number B says that it is required carrier to deliver only goods only to a specific name consignee. Yes, this is correct, because the state bill of lading, it specify that a carrier must be delivered the goods to a particular named consignee, right? So this ensures that only the intended recipient can receive the goods. Option number C, it says endorsement to transfer ownership. So what do you think? This is incorrect, because as I told you, it is a non-negotiable document. It is a non-negotiable. It cannot be negotiated, right? It cannot be endorsed. So since it is non-negotiable document, can you think it can be endorsed? No way. So a state bill of lading does not allow the consignee to endorse it to other party to transfer ownership. Now option number D, it is primarily used when goods are shipped without prior payment by the buyer. This option is also incorrect, because the state bill of lading are typically used when payment have been made in advance, not when goods are shipped without prior payment. This is more common in scenario where payment terms are secure, right? So correct answer to this question is option number B. So you must remember some key points related to the state bill of lading. So let me summarize it for you. So here you can see, let me show you. So these are the points. The first point, you must remember that a state bill of lading is a non-negotiable, right? It means that it does not allow ownership transfer during the transit. Second point, it is specify delivery to a named consignee, ensuring goods are delivered only to the person or entity, and it is used when payment has been made in advance, providing a secure transaction. So these three key points which you must remember regarding a state bill of lading. Friends, we have some more questions available. If you want me to discuss that also, please write yes in the comment section. If this video video was usually helpful to you, please write helpful in the comment section. यदि आप चाहते हैं कि आपको मैं बाकी क्वेश्चन भी बताऊं, क्योंकि हमारे पास और भी क्वेश्चन अवेलेबल है, तो आप यस लिखें कमेंट सेक्शन में. और फ्रेंड्स, यदि आपको इससे रिलेटेड कोई कोर्स चाहिए, इफ यू वांट एनी काइंड ऑफ कोर्स रिलेटेड टू द फॉरेन एक्सचेंज सर्टिफिकेशन कोर्स, प्लीज व्हाट्सएप मी ऑन दिस पार्टिकुलर नंबर. और जो भी, एंड इफ एनी पर्सन शेयर द क्वेश्चन आस्क्ड ऑन द 8th March examination to us, I will provide you maximum discount on the next certification course. Okay, so you can provide the question, memory based question on this particular number, right? So for 8th March examination. So that's all for today. Hopefully this video was useful. Thank you.